Hello, everyone. Wednesday was a rough session for the stock market, and that should be of no surprise as it was a Fed day. And Ben Bernanke came out with all of his statements in the FOMC meeting as it wrapped up their two-day event. And indications were that tapering what is going to begin at some point next year with unemployment expectations being reduced. That definitely means that they should start slowing down their quantitative easing POMO program. And with that being the case, the market took that as bad news. Bonds and stocks sold off, yields rose, and basically it was a pretty ugly session overall. And that is unfortunate, as yesterday we did get a cosmetic buy signal. It was a legitimate buy signal on the Russell 2000 and the Nasdaq. The S&P 500, Dow Jones Industrial Average, New York Stock Exchange did not trigger buy signals, but the Russell 2000 being the most important index by hitting new highs, that was a very significant signal overall. The immediate reversal right back into our May highs and June low consolidation area, or whatever range that we are in, whatever you want to call it, is not good. But it shouldn't be any surprise. As I stated yesterday, June follow-through days or June buy signals going back 180 years has only a 20% or so success rate. So this was not unexpected, and nothing about today's action was shocking. There's good news for the bulls and good news for the bears. The good news for the bulls is that despite the breakdown, we're still above the 50-day moving average. Volume was below average, but good news for the bears is that volume was higher than the day before, giving us another clear distribution day. However, I will remind everyone, how has all the piling up of distribution days worked during the past 5 years? About 75 years before that of data indicated that you get this many distribution days, you sell off. Since 2008, it's been the exact reverse. So what I would appear by looking at some of these charts, look at this, like FAS. Last time that we saw this happen with FAS back here in November, we rallied higher. Last time we saw this happen in March, we rallied higher. So we see it here again. So it wouldn't surprise me if we rally higher. But the main point is that we're back in neutral, and that's where we should remain to stay. And as everybody here at Big Wave Trading has warned since that down day on May 22nd, expect a very choppy, volatile summer. So far, that is indeed what we are getting. Still, with that being the case, since we're back in neutral, I want to go ahead and add back to the hedges. And I know that we got rid of half of the SQQQ hedge that we had remaining this morning. But listen, that was a legitimate break below 20-day moving average. If we were up 2% today, you sure would be happy that we got rid of it. But with the reswitch, it means we need to rebuy it back, which means a little bit extra in commissions. But now it's time to add 5% of our account capital into SQQQ in my risk account. In the non-risk account, I'm going to go ahead and switch it over to the financials, and I'm going to go 5% long FAZ. They're not really breaking down here. BNS is kind of breaking down. Legg Mason is breaking down. But JP Morgan, Morgan Stanley, Goldman Sachs, and all the Bank of America and all the big boys, Wells Fargo, they look fine. And even MasterCard, Visa, and American Express look fine. So this is just a hedge play on if yields do continue to rise like they are after hours today. I would assume that some of the bank stocks will continue to get hurt, just like the home builder stocks already are. Besides that, though, it wasn't that ugly. We had VRX look very solid today. XOOM and IPO had a good day. Ruckus Wireless did well. We had Netflix hit new highs today. Adobe Systems hit new highs today with a nice gap up. And then we had Mercado Libre gap up with a pocket pivot buy point signal. Gulfport Energy hitting new highs, $52. And then ICPT, Intercept Pharmaceuticals, had a viable gap up. Not one that I would have taken, but technically it would have been a viable gap up and rallied 16% today. So it isn't that ugly. And then on the other end of sells, I only had two sells. WDC is a 25% sell and was barely a 25% sell, as it is barely closing below the 20-day moving average by 1 penny. If this damn stock closes at 63.58, it's not a sell today, but it closed at 63.57, makes it a 25% sell signal, and that is out of there. And then the most important lesson is VIPS. VIPS is a 100% sell signal today, and if you're asking me how can it be a 100% sell signal when it's still holding those ultimate lows of our last 50-day moving average break at 2710, I will quickly explain that. This breakdown below the 50-day moving average is a confirmation heavy volume breakdown below this average. When it first broke down here in May, we still had gains and it was still possible for it to reverse higher on heavy volume. That's why it was only a 50% sell, not a 100% sell. It did indeed reverse higher, but whenever it retook the 50-day moving average on heavier volume, you can see it closed well off the highs. So that heavier volume reversal well off the highs, including these two big red bars here and this big initial red bar that started the whole selling VIPS, is not a good sign. As VIPS went along around the 50-day moving average, it was lower volume, never really any heavy volume accumulation, and now you have another big tall red bar breakdown. And on top of that, since that initial basically churn day reversal on the 15th of May, we've had basically max red bop in the stock the entire way. So that's even like triple confirmation on this stock. And if you look at arithmetic chart, you can see it's gotten quite ugly. And just like GNMK, remember whenever we fully got out GNMK, that sure did pay off as it has cratered since then. So VIPS could be the next. And on top of that, INSM is on watch. INSM, if it closes below the low right here of 1182, it will be another partial sell. Also, Perry is inches away from being a full sell. It closed at 1211 today. It closed below 1207. We'll make that a full sell. And then IPAR was almost a partial sell, but not. It's now closing below the 10-day moving average, lower volume. A close below the 20-day moving average. We'll have to get rid of 25%. So those are also only the three stocks on watch. So not that terrible after such a rough session. What is terrible, though, is that the high-yield bonds, JNK, junk, that's getting ugly. HYG, that's getting ugly. And HYD, high-yield composite bond index, that's getting ugly. And these things normally, if we go back to 2008, here we can see on HYG what it looked like before we, this thing got ugly before we sold off. And so always my precursor to a possible huge sell-off is whenever these bond ETFs are looking bad. And JNK and HYG and HYD sure are looking pretty ugly. Still, anything can happen in this QE market, but that's definitely something to watch without a doubt. So once again, we're going to go ahead and go 5% FAZ in one account, 5% SQQQ in the other account to hedge. VIPS 100% sell, WDC 25%, INSM, Perry, IPAR on watch. Overall, though, it's neutral. I would not be committed to the bull or bear side, and if you are being ballsy beyond all logical explanation, because there is no real tell to where we're going to go. Individual stocks look very strong. However, the overall market looks weak, and if Apple's any indication of how weak that this stock looks, that could easily spill over to the NASDAQ if Apple decides to roll over and break new lows. However, we continuously see rotation into leaders, I think we'll be okay, but we're going to have to get past this summer first, so expect more of this to come.